Hey everyone, and welcome. Today, we are diving into a financial toolkit that every single Canadian should know about. I'm talking about registered savings plans. The best way to think about these is like a set of powerful, specialized tools, each one designed to help you build your financial future one specific goal at a time.
So let me ask you, are you trying to save up for a child's education? Or maybe you're dreaming about that down payment on your very first home. Or hey, maybe you're looking way down the road, trying to plan for a really comfortable retirement. It can feel like a lot, right? Trying to figure out the best way to tackle these huge life goals.
But here is the really good news. You don't have to go it alone. Canada has actually created this whole set of registered savings plans, and each one is like a specific tool that's perfectly designed for a specific job. Seriously, if you know which tool to use, you can build your savings way faster and a whole lot more efficiently.
So, you ready? Let's open up the toolkit. First up, we've got the tools for two of life's absolute biggest milestones, getting an education and buying your first place. This right here is the Registered Education Savings Plan, or as most people call it, the RSEP. Its one and only job is to help you save for a child's education after high school. That's it. Super focused.
Okay, so how does this thing actually work? Well, a subscriber, that's usually a parent or grandparent, opens the account for a beneficiary who is the student. Now, the money you put in won't give you a tax deduction right away. But, and this is the best part, it acts like a magnet for government money through grants. It's literally free money to boost those savings. And you can use it for pretty much anything post-secondary. Trade school, college, university, you name it. And here's a key number you're going to want to remember. $50,000. That's the lifetime contribution limit for each beneficiary. That's the max you can put in, and that doesn't even include all that awesome government grant money we just talked about.
So, what about getting the money out? Let's make this real with a quick story about Leo. Say Leo needs $8,000 for trade school. The $6,000 his family originally put in, that comes out completely tax-free. Only the other $2,000, the part from grants and investment growth, gets taxed. And here's the genius part. It's taxed in Leo's hands. And as a student, he's probably in a super low tax bracket. It's a really smart system.
All right, let's grab the newest tool in the kit, the First Home Savings Account, or FHSA. And just like the name says, this is a laser-focused account designed to do one thing: help you save up for your very first home. And you guys, this thing is powerful. Why? Because the FHSA basically cherry-picks the best features from two other plans. Your contributions are tax-deductible, so they lower your taxable income right now, just like an RRSP. But then, when you pull the money out to buy your home, the whole withdrawal is completely tax-free, just like a TFSA. It really truly is the best of both worlds for anyone hoping to buy a home.
Okay, let's switch gears. We've talked about those big early life milestones, but now let's talk about the long game, retirement. These are the tools you're going to use to build the blueprint for your financial freedom later in life.
And the absolute cornerstone of retirement saving in Canada is the Registered Retirement Savings Plan, the good old RRSP. For decades, this has been the go-to account for Canadians who are planning for their life after work.
The key to understanding the RSSP is its 3 stages. First, you contribute. Every dollar you put in, up to your limit, can be deducted from your income, which, often means a pretty nice tax refund come April. Second, your money grows tax-deferred inside the plan. And finally, you withdraw it. You only pay tax when you take the money out, which for most people is during retirement, when their income and their tax rate is probably a lot lower. Now, an RRSP doesn't last forever. It has a very clear life cycle. You contribute all through your working years, but there's a hard stop. You have to close your RRSP by the end of the year you turn 71. And at that point, you have to convert it into something that's designed to pay you an income.
And that something is usually a Registered Retirement Income Fund, or a RIF. The easiest way to think about a RIF is that it's the mandatory payout phase of your RRSP. So if the RRSP is for putting money in, the RIF is for taking money out, turning that nest egg you built into a steady stream of income for your retirement years.
All right, let's check out our final category of tools. In here, we've got the ultimate financial multi-tool, the Swiss Army knife, if you will, and a very, very important specialist plan. Let's talk about the tax-free savings account, the TFSA. And please, don't let the name fool you. It's so much more than a savings account. It's an incredibly powerful investment account. The key word you need to focus on here is tax-free.
This slide breaks down the great Canadian finance debate, RRSP or TFSA. Here's the difference in a nutshell. With an RRSP, you get a tax break now when you contribute. With a TFSA, you contribute with after-tax money, so there's no immediate break. But the magic happens later. All the growth, your interest, dividends, capital gains, it's all completely tax-free. And so are your withdrawals, for the rest of your life.
But, and you have to listen to this, there is one critical TFSA rule you need to know. When you take money out, you get that contribution room back, but not until January 1st of the next year. So if you pull out $5,000 in July, you can't just put it back in August unless you already had the room. You have to wait. It's a super common mistake, and it can lead to penalties.
And speaking of penalties, this is a number you do not want to get familiar with. The government is very serious about these contribution limits. If you put too much money into your TFSA, RRSP, or FHSA, you'll get hit with a penalty tax of 1% per month on the extra amount. It adds up incredibly fast, so you've always got to track your contribution room.
And finally, let's look at a crucial specialized plan, the Registered Disability Savings Plan, or RDSP. This is a long-term savings plan that's specifically designed to help support the financial security of Canadians with disabilities who are eligible for the disability tax credit.
Kind of like the RSSP, the RDSP is also designed to attract very generous government help, this time in the form of grants and bonds, which can give a huge boost to the savings in the plan. The whole point is to provide peace of mind and financial support for a person over their entire lifetime.
So there we have it. We've laid out all the tools on the workbench. And you know, the most important part of any project is choosing the right tool for the right job. Well, your financial journey is no different.
Let's do a super fast recap. Got it? The RSEP is for education. The FHSA is for that first home. The RRSP helps lower your taxes right now while you save for retirement, which you'll eventually take out of an RRAF. The TFSA is your flexible, tax-free powerhouse for pretty much any goal. And the RDSP provides critical long-term support for persons with disabilities.
Of course, this has just been a quick tour of the toolkit, right? Each of these plans has way more powerful features and really important rules you should know about. So with that in mind, we're actually going to be releasing a deep dive explainer on every single one of these plans. So keep an eye on the description for links as we get those posted.
And that just brings us to the final question, and it's for you. Looking at your own financial goals, at your own life, which one of these powerful tools are you going to add to your toolkit first?